Hey, welcome to our latest explainer. So, for weeks, it really felt like investors in Asia were just hunkering down, playing defense. But, just when you think you know the playbook, things change. Suddenly, we're seeing this powerful kind of unexpected rally sweeping across the region's stock markets. So, what on earth is behind this sudden good mood? Let's get into it.
So that's the big question, right? Why now? After all that caution and sitting on the sidelines, what's lighting a fire under Asian stocks all of a sudden? Well, it turns out the answer is this really interesting combination of signals coming from two of the world's biggest economic heavyweights.
And make no mistake, this isn't just some small, isolated blip. The rebound is happening pretty much across the board. You've got Japan's Nikkei pushing higher, Hong Kong's Seng is bouncing back strong, and the wider regional index is showing gains all over. But here's what's really interesting. Look at who's leading the charge: tech, exporters, and financials. That tells you something important. The buying is specific, it's targeted, and it's zeroing in on the very companies that are most tuned in to big global economic shifts.
Okay, so to really understand this rally, we've got to look at two key drivers. Let's start with the first one, and that's the U.S. Federal Reserve. It's a perfect example of how a decision made in Washington can send these huge calming waves all the way across the Pacific. Here's the absolute heart of the matter. Investors are now betting, and betting big, that the U.S. Federal Reserve is finally done hiking interest rates. Inflation is cooling off a bit in the U.S., the job market is softening, so the consensus is building that the Fed is just going to hold steady for a while. This single expectation, the pause, is the first huge pillar holding up this rally in Asian markets. And when the Fed pauses, it creates these really powerful ripple effects. For one, it usually means the US dollar doesn't keep getting stronger. For Asian economies, that is a huge sigh of relief. It lowers the risk of what they call capital flight, money rushing out of the country, and it makes their tech stocks and other growth companies look way more attractive. All of a sudden, foreign investors are thinking, hey, maybe it's time to put our money back into places like Japan and South Korea. It's just this cascade of good news.
All right, let's move on to the second major driver, which really builds the case for this whole rally. We're shifting our focus over to China now, where the story is a little more subtle. I love the subtitle here. When not getting worse is good news. That really says it all. So the latest economic numbers that came out of China, they weren't exactly spectacular. They didn't scream massive rebound. But what they did signal was that things stopped getting worse. And for a market that had been bracing for a continued slowdown, just the signal of stabilization, that the free fall was over, was enough to totally change the mood.
So you might be asking, why was just holding steady enough to get everyone so excited? Well, it comes down to three main reasons. First, it basically took the fear of a worst-case scenario, a huge economic collapse, right off the table. Second, for companies all across Asia that sell things to China, it gave them a much clearer picture of what demand might look like. And third, it suggested that Beijing's targeted support measures are actually working, which means they probably won't need to resort to some massive, economy-bending stimulus package.
So let's just put it all together here. What we've got is a rally standing on two really strong pillars. On one side, you have the US Fed basically giving the world some policy stability. And on the other side, you've got China providing some much-needed regional economic stability. It's this 1-2 punch that has really let investor confidence come flooding back.
Okay, so we know why the rally is happening. But what is it all telling us? What's the message? Well, we can actually read the clues by looking at how different things are behaving. Stocks, currencies, even the way international money is moving around. And to really get what's going on, you need to understand this key term: tactical risk on. This is not one of those wild, buy everything in sight rallies. Nope, it's way more cautious. Think of it like this. Investors are dipping their toes back in the water, adding a bit of risk, but they're doing it very strategically. It's based on their confidence in the policymakers, not because they expect some massive economic boom tomorrow.
This table really breaks down those signals for us. In stocks, the buying is selective. They're targeting those exporters and tech firms we talked about. In the currency markets, we're seeing Asian currencies finally stabilize, which tells us that the fear of a runaway US dollar is fading. And maybe the biggest signal of all is in capital flows. Foreign investors are finally net buyers again. That means more money is coming in than going out after weeks of everyone playing defense.
So where does this all leave us? Well, it's leading to this really fundamental shift in what investors are actually worried about. The whole conversation is changing, and a brand new question is taking center stage for the future of these markets.
And this quote it nails it.
For months, the only question that mattered was, how high are US interest rates going to go? That's all anyone talked about. But now, that question feels like it's been answered. The new obsession, the new dominant question is, okay, great, how long will this period of stability actually last?
Which brings us to the ultimate question, doesn't it? With the Fed on hold and China finding its footing, is this just a short-term relief rally? A quick gas for air? Or are we looking at a genuine, real turning point for Asian markets? That is the billion-dollar question that everyone is trying to figure out right now. Thanks so much for tuning in.